We're joined today by Alexander Scanlon, Managing Director of Barton Gold. Alexander, thanks for your time.
Thanks for having me.
Gold in South Australia, bringing a project to fruition at the exact right time. Couldn't be a better time to be thinking about production for a gold asset.
Yeah, absolutely. Look, we acquired all of these assets some years ago on the thesis that at that time the gold market was mispriced, the assets were misunderstood, the region was underexplored. We wanted to build up a much larger platform rather than start operations then. So we do own a mill. We always could have started operations, but we've instead focused on building or identifying a larger scale expansion project right next to that. That's our Tunkillia project. So now we've crystallized a much larger platform, and these two assets are essentially in parallel development pathways. And we're quite thankful through a lot of hard work that we've got this done just at the right time for the gold market to come back and sort of be in our favor.
And you've recently put out some compelling study results on that stage 2 expansion. What were some of the headline numbers, but more importantly, what did it tell you about this project and how you plan to develop it?
So the original test that we did of these assets was based upon essentially testing the premise of capital efficiencies, both in terms of operating and capital costs. So we designed this as a 5 million tonne per annum project, and we ran an initial study last year, which we published in July 2024. And what that showed us was that sort of the economics or the horsepower that you can get out of a plant of that size paired very nicely with this pit. So it's a big bulk open pit model. We at the time were running a 0.9 gram head grade, and we had an all-in sustaining cost of 1,900 Australian, which sort of put it in the bottom quartile in Australia and globally. But that was actually based on some very conservative assumptions that essentially were inefficient use of energy. So we've gone and done an optimized scoping study, which we just published on Monday morning. And we essentially did a lot of new combination test work. We remodeled the circuit. We chose a more optimal pathway. We actually reduced power consumption by about 30%, which is a huge savings. And we actually took all those savings and we pushed them out into the mine design. And so what that did, in conjunction with other things, including CapEx savings and other efficiencies, is it allows us to produce nearly 1 million ounces in this pit. And this is constrained at 33,500 Australian dollars. So we're thinking more in a reserve sense of a constrained subset of our 1.6 million ounce resource. But the headline results from that are about 120,000 ounces of gold per annum, about 250,000 ounces of silver per annum, doing that for about 8 years, and it generates, on net about $2.7 billion in operating free cash, about 73% equity IRR unlevered, and a 0.8 year payback. And to put that in context, the upfront capital cost is just a hair under 400 million Australian dollars. So that includes pre-strip and everything. So the economics at a high level are very strong, but one of the things that makes this asset particularly compelling from the operational and financial side is the project is of course broken down into various stages. There is a higher grade zone in the middle of the project, so it's what we call our starter pit. And when we think about the economics of that pit, the grade there is about 40% higher. And what it means is the first 5 million tons that go through the mill are not producing 120,000 ounces, they're producing 180,000 ounces. So our cash cost of production on those ounces is actually 997 Australian dollars, about 600 US dollars. So the first 12 or 13 months will produce about $800 million in free operating cash flow. The first 2.5 years produces about $1.3 billion in free cash flow. So it's a project that pays itself back 2 times over at the current market price, just from within the first 16% of the mine plan. So it's a very, very strong financing profile. And that now tells us that, as we suspected, okay, it's really time to hit go on this. Obviously the gold price has conspired to assist this conclusion. So what we're now doing is essentially expediting and bringing forward some of the mining lease and PFS long lead items, which is essentially the environmental regimen, which in South Australia we're fortunate we can pre-agree with the government. So we're going to start our so-called scoping report, and we pre-agree the work that needs to be done. This essentially becomes the terms of reference for our mining lease, but you typically have 2 years of water studies, 18 months of flora and fauna. So we're just going to get that going right away and put ourselves in a position to apply for a mining lease as soon as possible.
And you mentioned before you do have infrastructure adjacent to this stage 2 expansion. How important is that, and how do you look to leverage that to the benefit of this project?
The leverage point is a very important word. We measured the Tunkillia project as a standalone basis. So we kind of dropped a dome over it and we said, let's make sure this can stand on its own and perform very well on its own. What we are now doing with this kind of going into the standard commercialization and development pathway, we're now going back over to what we call our stage 1 area. And the strategy was to focus on a large scale outcome, so that the stage 1 was a pathway to a large-scale destination, right? We could have started production at our existing mill at 20 or 30,000 ounces per annum, and the question would always have been, what is next? We worked out what is next first, and then stage 1 is actually a step ladder and not a stumbling block. So the idea is now we're going to come back over here. We have a whole bunch of different bodies of resource around that existing mill that we haven't even really talked about for 4 years because we've been doing this. We're going to have a series of resource upgrades. We're going to publish studies for 1 of 3 different plant reconfigurations. And we'll basically, in the next 3 to 4 months, come out and say, here's all our little Lego pieces. Here's our mill. Here's how we're going to put them through the mill in what order. Here's how we're going to do the reconfiguration. Here's what it's going to cost. Here's what it's going to produce. But what that will do is sort of unite these 2 platforms into part A, part B. Start today at 20 or 30,000 ounces per annum with a relatively small amount of capital, and then self-fund all the way up to 150,000 ounces per annum.
Exciting times ahead for Barton Gold and its shareholders. Alexander, thanks for your time.
No, thank you.